Dave, thank you so much for joining us today.
Thanks for having me, Elijah. It's a pleasure to be here again.
All right. Well, I just wanted to first discuss the markets. Now, you've said that the markets are extremely overvalued right now, and that basically they're not reflecting the fundamental reality in the economy. You've said that the economy fell off a cliff a couple of months ago, and the markets are just not reacting to that at all. They're, near all-time highs. Can you explain a little bit about this?
Sure. If you look at the actual kind of grassroots fundamental economic data, and not most a lot of the economic reports that hit the tape, and I think this is by design. They're what you would call soft economic data, where a lot of these indices that are supposed to measure what's going on in the economy are based on people's feelings about what's happening and people's feelings about what the next 6 months are going to be like, and that's how the surveys are constructed. Like the National Association of Home Builders Sentiment Index. It used to be called the Sentiment Index. Now they just call it the Market Index. So everyone thinks, oh, well, that's what the market is. And it's a sentiment index. It's a home builder sentiment index, and half of the index is comprised of builders' perceptions of what things will be like in the next 6 months. Well, no one can know that. And how can a home builder at all be optimistic when the Fed's raising rates? That's believe it or not, there's an inverse relationship between housing sales and interest rates. And when interest rates go up, housing sales go down. So, but if you look at what companies are reporting, there's very few companies that are reporting an increase in revenues, and if they are reporting an increase in revenues, it's at the expense of profit margins because they have to discount their pricing. They either offer discounts, massive discounts, like the auto industry is doing right now. I mean, they're discounting $50,000 trucks by $10,000. I mean, that's knocking 20% off the price, and it eats into their margins substantially, actually. You got retailers. Some of the retailers I've been looking at recently, their inventories are going down because they're basically conducting fire sales, just to move product and generate cash flow so they can pay off debt. So what's to me, no one pays attention to this, and this is the kind of data that doesn't get reported in the mainstream media. But we saw yesterday that used car prices collapsed over the last month, and that's a function of both the amount of cars coming off lease that are being distributed through the used car system. So you got a big inventory of used cars building up, and it's also a function of demand, and the demand is a function of auto lending. I mean, we're seeing, banks are cutting back on the availability of credit, and we've seen that over the last couple of weeks. All the data that's coming out from the amount of lending banks are doing, and that's, if you look at a graph of it, it looks like it's falling off a cliff. And again, it's a function of two things. It's a function of businesses aren't borrowing, and they're, the apologists are blaming it on uncertainty over Trump, and that's nonsense. I mean, businesses aren't borrowing because they don't have anything to do with the money. There's not business opportunities out there because consumers, the 66% of the GDP, the consumer is dying on a vine. And it's also a function of banks saying, hey, we're not going to lend money because we don't think we're going to get it back. And you got bank economists that are looking out and they're saying, you know what, things are slowing down. Let's be a little more cautious on our lending. So, and then the other piece of information, I've been harping on this for a while. Retail sales are not what the government is telling us they are. They report a seasonally adjusted annualized rate number every month, and that's absurd. And if you actually strip even just the CPI index measure of inflation out of the retail sales, that, for the past several months, retail sales have been negative on a real basis, meaning inflation adjusted, because headline numbers aren't adjusted for inflation. So And when you look at behind what's going on behind that, you can go right to the Fed website, the St. Louis Fed, and pull up real disposable income, and it's been heading south since December of 2014. And all just points to the fact that the consumer in this country is tapped out, and that's going to translate into a decline in sales volume for housing, autos, uh, discretionary and non-discretionary purchases, as people have to cut back. Same thing in restaurant sales. Restaurant sales since late in the fourth quarter of 2016 have been literally falling off a cliff. And it's, this is a lot of data that doesn't get disseminated in through the financial media for whatever reason. You can attach whatever reason you want to it, but it doesn't get disseminated out there. So um, the underlying fundamentals of the economy are collapsing, and up until really the last couple of weeks, the stock market was kept moving higher, and it was becoming further and further dislocated from the underlying fundamental reality. And at some point, either the fundamental reality has to catch up to the stock market, or the stock market is going to catch down to the fundamental reality. And I think that's where it's headed.
Now, if what you're saying is true, that the economy is actually collapsing right now, what is the Fed doing raising interest rates at this time?
It's funny because you're seeing a lot of articles now where guys are coming out and they're just saying the Fed's clueless. They don't know what they're doing. And I honestly, I don't know. I'd love to be a fly on the wall in those meetings to see what they're discussing, because I have to assume that unless the 12 members or 10 members, whatever it is, of the FOMC, unless they're absolute hand puppets for the banking industry and for the powers that be that are running this country, unless they're just absolute hand puppets, they just spit out what's put in front of them by the Fed researchers. They have to see the real data, and they have to know what's going on. I think the Fed is, here's the thing, when you say hiking interest rates, does a 25 basis point hike in the Fed funds range, the Fed funds target range, does that qualify as an interest rate hike? I mean, Bernanke gave his famous, uh, tightening speech, or what, I forget what it was called, back in May of 2013, and that's when the target Fed funds rate was 0 to 25 basis points, and here we are, almost 4 years later, and the target Fed funds interest rate range is 0.75% to 1%. So have they really raised rates in the context of rate hikes? I mean, before they started this back in 2007, 2008, the Fed funds rate was at like 5.5, 6%. So you can't really qualify with what the Fed has done so far as an interest rate hike. I think the reason why they were just kind of nudging rates slightly higher 3 times is to try and save face, because they were losing complete credibility with everyone around the world. And everyone who has to go to the grocery store and spend money and has to pay bills, they know that inflation is a lot higher than the government saying it is. So to a degree, they have to, they lose their credibility as academic economists if they sit here and hold interest rates below 1% while inflation is starting to roar. And I think that's part of it. But probably the most important thing is they know what's happening to the economy, and at least now, they have a little bit of room to move interest rates down to try and jumpstart the economy when it really is evident to everyone that it's collapsing. And so I think those are kind of the factors behind what they're doing. The bottom line is, though, that what's being posited as an interest rate hike in the context of where interest rates have been historically, it's not really an interest rate hike.
I'd like to move our focus to the gold and silver markets. Did you want to first give us an update on where gold and silver prices have been, since the last time we talked, and where you see them going in the near future?
Sure. Well, we had a rip roaring rally in the sector in 2016, and it was long overdue. And there was a lot of pent up energy behind it. And I think that just sort of technically, it probably got ahead of itself. And make no mistake, I think everything that goes on in the precious metals market goes on in the face of massive central bank intervention to try and keep the price lower. So we had a bunch of momentum traders pile into the market last summer, and it kind of, the market kind of got ahead of itself in that sense, because you had a lot of hot money pile into it. Well, by late July, early August, all the technical indicators were flashing overbought, and it made it easier for the interventionists out there to engineer a sell-off in the market, even though a healthy pullback was probably warranted at that point to get some of the hot money out. And that's what we saw from August till mid-December. And then in mid-December, the market started to bounce again, and I think it's just kind of in the process of still kind of grinding laterally to up, while people, the sort of the marginal trader and the marginal buyer in the market gets more comfortable that the bottom is in. And once that happens, I think we're going to see this market go a lot higher. I think before the end of 2017, the market will be higher than the highs that it hit in late July of 2016.
Now, what about physical demand for gold? Because you recently put out an article saying that actually physical demand for gold is still very strong, even though some are reporting that it is decreasing.
Well, yeah, and it was actually a podcast that my Shadow of Truth partner and I, Rory Hall of the Daily Coin, and I recorded yesterday and published yesterday, and there's been some articles out there that look at mint sales and sovereign minted bullion sales, and that's largely a retail market. And for instance, if you look at, let's say the U.S. Mint averages 40 million ounces of silver eagle sales a year. Well, that's only 5% of the global silver market on an annual basis. And so, if you're seeing, there's been a big drop off in silver eagle sales this year versus last year, and to imply from that physical gold and silver demand are collapsing, is just absurd. Because at the margin, the retail buyer doesn't drive the market. The market for physical gold and silver is driven by, well, first and foremost, India and China. But after that, it's primarily Eastern Hemisphere central banks who are accumulating gold hand over fist, and by very wealthy investors and savvy, mostly European and Asian institutions who are accumulating large quantities of physical gold. And so to ignore the non-retail market is and project out that, oh, demand for physical gold is collapsing, I mean, that's insane. So we've seen a very sharp rebound in the amount of gold that's being imported into India after the government tried to squash it several months ago. In fact, the imports into February into India were 3 times what they were in February of 2016. I mean, almost 100 tons of gold was imported into India in February alone, and that doesn't include the doré bars that are going into India. Those are the bars that go directly from mine producers, and they're about 85% pure. They're not refined down. And then there's also a bunch of smuggling, and I don't know why these organizations that keep track of the amount of gold going into India, they just completely ignore smuggling. But it's been, I've seen several reports on how much gold gets smuggled into India every year, and the range is somewhere from 200 to 300 tons. So on top of what India officially imports in a given year, you have to add 200 to 300 tons to that to get the real demand going into India. And China, the same thing. The official accounts of gold going into China are based on what's officially announced as gold that's exported from Hong Kong into China. But that's only one port of entree for gold. There's also Shanghai and Beijing, and those numbers don't get reported, and that's by design. In fact, you can, if you Google it, there was a South China Daily News article when China opened up Shanghai and Beijing for imports a couple of years ago, and the article specifically said that the central bank and the Chinese government wanted to uh, make make the amount of gold going into India more opaque, and that's why they're not reporting those numbers. So, but if you look at how much gold is being withdrawn from the Shanghai Gold Exchange, now that's a fairly accurate indicator, other than the People's Bank of China, of the total demand for gold at any given point in time. Any gold that's sold in China, once it's been imported, has to go through, or mined, has to go through the Shanghai Gold Exchange. And the only one exempt from that is gold that's accumulated by the People's Bank of China. So if you look at withdrawals from the Shanghai Gold Exchange, that's a much better measure of how much gold is being purchased in China, X the PBOC. And there's just no way to know how much the People's Bank of China is buying unless you want to believe what they report every month, which I don't know anyone who does.
Now, can you explain more about the story with regard to India and gold? Because you said that the Indian government tried to suppress the demand for gold. Did you want to explain how the Indian government tried to do that?
Sure. Well, part of the problem for India is that they're they run a huge balance of payments deficit, which means the cash going out of the country is greater than the cash coming into the country, and that's because of all the gold that gets imported into China. I mean, into India. And so there's been a couple times over the last few years where they've tried to put brakes on that, either by raising the import duty or their most recent stunt, which I know everyone who's listening to this is well aware of it. They basically got rid of the most commonly used cash currency denominations in India. And the reason why they did that is Indians typically pay for gold with cash, and they wanted to make it harder for Indians to use cash to buy gold. Um, but what's happened is, and you saw a big drop off in the amount of gold going in being officially imported into India in November and December. Those numbers have bounced back hugely because the market's adapted to this, to the new, the removal of the most commonly used cash currencies out of the economy. What's interesting is the Indian government did that at the at the expense of the economy because it hurt the economy. Some people will say, and I actually believe this is true, that the directive to do that came from the BIS in order to put a significant break on the amount of gold going into India, because as you and myself and everyone else out there listening to this have read the reports that there's a growing shortage of physical gold that can be delivered into places like China and India because of the enormous amount of physical demand at these price levels. I think that the Western central banks, led by the BIS, needed to put a brake on the amount of physical gold going into India so that they could be redirected and delivered into China. Because I think that the market interventionists in the precious metals market in the Western Hemisphere, I think they're caught off guard by the amount of gold that's being consumed, if you will, by China and India and Russia and a bunch of the other Eastern European countries. And India is essentially a lapdog for the United States, the people running India. And so that's the U.S. government's not going to be able to, or even just the Western central banks, they're not going to be able to stop gold going into China, but they can take short-term measures to make sure that gold going into India slows down. Well, the Indian market's adapted to that. They've adapted to the new regulations, et cetera. And we're seeing a huge bounce back effect going on in India. And now you're going into what is the second largest seasonal period for gold buying over in India, ahead of wedding and festival, the spring wedding and festival season. And I don't think there's gonna be anything that can be done to stop the flow of gold going into India unless they just say, okay, no, just completely cut off official imports into India, and you'll still get gold going into India via smuggling. It'll just be, there won't be as much. But I don't know that that'll happen per se, because if the government did that, they'd probably have a revolution on their hands. So I mean, the point being is that the demand for gold in India is bouncing back. It's bouncing back strongly. And when you look at India and China combined, those two countries are buying at least as much, if not more, gold than is equal to the amount of gold that gets produced globally by mines. And so you basically have a supply and demand deficit. And that's why that's why we're seeing the price of gold go higher, and I think that's why we'll see the price of gold go a lot higher this year.
All right. Well, Dave KRANZLER, thank you so much for joining us today. Before we let you go, did you want to share with the viewers where they can find you and any last thoughts you had?
Sure. My website is investmentresearchdynamics.com, and from there I offer a short sellers journal, which is a weekly subscription publication where I review mostly the economic data that doesn't get reported in the mainstream financial media. And then I also have a mining stock journal, where that's a bi-weekly subscription publication, and I review the gold market and make mining stock recommendations. And you can access both of those subscriptions on my website. In terms of, I think that, like I said earlier, I think that by the end of this year, at some point, if not at the end of the year, gold will be a lot higher than it is now. It'll be a lot higher than the highs that it hit in 2016. And I also think that we're probably headed for a major accident, in the downside accident in the stock market. And I think that 2017 could turn out to be a very difficult year for most people if they continue to stay invested in the stock market. I think at the very least, people need to move their money out of the stock market and into short-term treasury bill mutual funds. Those are short of buying gold and silver, physical gold and silver, that's probably the safest place you can put your money right now.
Once again, Dave KRANZLER from Investment Research Dynamics, thank you so much for your time today.
Thank you. Thanks for having me.
Click here to watch Reluctant Prepper's latest interview with Rob Kirby. In this interview, Rob Kirby discusses what he would tell President Trump if he had 30 seconds with him.